Thank you again for everybody for joining. My name's Nick Worthing. I'm with American Mortgages, and I'm based out of our Bangkok, Thailand office. For those of you who are new to this webinar series, or maybe just getting to know us, I'll give you a quick update, background, just who we are as a company, what we do, and how we can help, and then we can dive in to today's agenda, which is the two exciting loan programs that a lot of our clients are using to navigate the current market. So, like I said, we're American Mortgages. We're actually based out of Singapore. We are a mortgage brokerage company that's focused solely on foreign national and U.S. expat and real estate investors with properties in the States. So all of our clients are outside of the U.S., whether they're citizens or non-citizens, and all of them have properties that they're either purchasing or refinancing in the U.S. Because all of our clients are overseas, all of our team is also overseas. Like I said, I'm based in Bangkok, corporate offices in Singapore, and we've got loan officers throughout Southeast Asia, Europe, Canada. So the focus and the niche that we like to have is somebody in your time zone. There's no need to wait to speak to somebody in the U.S. There's a loan officer in your area able to help you process a loan from start to finish, and there's no need to go to the U.S. to close the loan. So just a quick background on us as a company. Again, we're very focused on these foreign national loans. We're very comfortable in getting them done. And we have a good track record of doing so. So with that being said, I will jump into today's webinar topic, which is two exciting loan programs that our clients are using to navigate the current market. If you are following the real estate market or really any asset class worldwide for that matter, the times have been extremely volatile. There's a lot of uncertainty. There's just, I guess the best way to put it is there's a lot of uncertainty what's going to happen in the near term. And our team works very hard to identify strategies and put out programs and that are able to help our clients continue to navigate the real estate market. Because I think if you talk to anybody that's been in investment real estate for quite some time, the one thing they'll tell you is it's always a good time to buy real estate. If you have the right time horizon on the deal, then it's just, there's not a lot of ways that you can go wrong. And I think a perfect example of that is a lot of our clients that we are working with now actually started or significantly expanded their real estate portfolio in the US after the 2007 and 8 housing crisis. So that was a time, again, when there was extreme volatility and uncertainty in the market. Nobody knew where the bottom was or what was going to happen. But people were still diving in, particularly foreign investors were still diving in, purchasing real estate. And I think if you talk to any one of them now, they're very happy with that purchase. Because the returns have gone quite well. So, but with any changing environment, it's definitely important to stay nimble versus how we finance these things, how we underwrite these loans, and how the clients are continuing to purchase these. So, over the last, before I jump into those two, I'll give you just some perspective on where we started the year with rates and where we are now, and then we'll talk about the loan programs because it'll play into that nicely. So. When we started the year in January and some of February in 2022, rates on the conventional side, so these are U.S. citizens purchasing homes they're going to live in, those rates were low threes, even high twos at one point. It was just rates were at a rock bottom. Foreign national market we were closing loans in late January in high threes, low fours. And then basically since February, rates have continued to increase. To where we are today in the conventional market. So again, a U.S. citizen buying a home they're going to live in is about 7 to 7.5%, depending on the day right now. And a foreign national is going to be starting at about 8.5%. So rates, doubled within the course of a year. Not something we see every day, and it's definitely it's definitely changed the real estate market. So one thing that we noticed, or that everybody noticed and experienced that was in real estate last year and earlier this year, is the competitiveness and struggle to be able to get a home in the U.S. I mean, we had clients that were pre-approved for mortgages at 4 or 5%, but they just couldn't get a home without finding themselves in a bidding war and going 10% or 100. Some cases we've seen homes go 300,000 over asking price, and even though you have a great rate, you're having to purchase way over and put yourself in a position where you're having to bid way over asking price. And it's just not a good or healthy environment for anyone. So what the rising rates have done and what the benefit for the rising rates have done is it really has slowed the market in the States. So the U.S. Buyers of real estate in the U.S. are mainly people buying real estate that they're going to live in. These people are purchasing a home based on what their monthly mortgage payment is. That's how they're deciding how much they can afford to buy to buy the loan. So earlier this year, they could have afforded a home that was a lot more expensive. The loan amount was a lot higher because rates were at 3 or 4%. Now with rates at 6, 7%, the amount of home that these buyers can afford has come way back. And what it's done is it pushed a lot of these people onto the sidelines and out of the market, which has taken away a lot of the competitiveness. I'm not saying that the most important, the hottest markets still aren't competitive, but they're certainly not as competitive as they were in January, February of this year. We've had over the past couple of years, we've also had a lot of people that have said to us, I'm very interested in the US market. I would love to dive in, but I feel like real estate prices have had just a really good run over the past, years or decade. And I'm fearful that I'm buying at the tip, and the market's a bit frothy. I'd rather sit on the sidelines to see what happens. And I think if you're in that mindset, now is really the time where you should be paying attention and getting involved and really focusing on how you can identify the right opportunities, because we have started to see prices come back in certain markets. We are starting to see homes sit on the market longer. Clients are coming in with asking, offers on homes at or under asking price, which was unheard of earlier this year or last year. If you put in an offer that was at or under asking price, you just weren't even entertained. And now that's with the slowdown in the market, the sellers are having to entertain these and bring prices back. So I think as an investor with a long-term horizon, there's really not a better time to buy in the US than right now, because when rates do come back, prices will go back up. So if you're trying to time both, it's probably not going to work in your favor. And the idea and what a lot of the experienced real estate investors that we work with do is they'll take the higher rates, buy the property, and then when rates come back, which they will refinance the loan at that time, maybe pull some equity out. So if you have a long-term play, I just don't see how you can go wrong with U.S. real estate. So that being said, let's dive into the program for today, which is, again, 2 exciting loan programs. So one thing or a couple things a lot of our clients tell us, or a wish list for a lot of our clients when we're speaking with them are easy underwriting, simplified underwriting, not a lot of documents required, or the documents that are required, if we can make them as easy as possible for them to retrieve or to generate in a different country. And then also the highest, typically the request is the highest loan amount, lowest down payment. So for those of you that have been with us for quite some time, you'll know that there's basically 2 ways a foreign national can qualify for a loan in the States. One, they can either use their personal income in their home country and document their income, document their liabilities, and go through a conventional underwriting process. And the second, which is by far the most common way for our clients, is basing the underwriting just on the property that they're buying itself. So there's no need to provide any personal documentation. There's no need to document all your liabilities in your home country. Everything for the loan underwriting is focused on this property that you're buying. So that means when you purchase a home, you have a home under contract, an appraiser will go out to the property. They will tell us, provide a report that says the home's worth, say $300,000, and the home would rent for, say, $3,000 a month on a long-term lease. As long as that, when we're underwriting it to the property's cash flow, as long as that $3,000 a month in rental income that the appraiser has identified is enough to offset the mortgage payment, the loan moves forward. It's really as simple as that. It's a very quick and easy process. And all of last year and earlier this year with rates, at rock bottoms, that worked really well, just because rates were so low, which resulted in payments being so low. The rental income that came on the appraisals, it always offset at the high LTVs. It was just a seamless process. What has changed is rates. As we got into the summer months, rates started ticking up to 6, 7% for the foreign nationals. And the one thing we started to see was, even though rental yields have increased year over year in a lot of the country, documenting those increased rental yields on an appraisal has become extremely hard, and I think that'll be the case for the next few months. So we started seeing mortgage payments start increasing, and say that same home that generated $3,000 a month in monthly rent, the payment may now be $3,500 a month because of the increased rates. So in that situation, we were seeing clients having to put more down payments into the purchase to bring the loan amount down and bring the monthly payment down until they matched. That's a typical cash flowing loan. Again, works great when interest rates are low, but as interest rates increase and stay at this level, we need to find a way to help our clients put less money down and just kind of achieve the same goals they had when rates were at a low. So that's where today's loan programs come in, and the first one I'll speak about is it's called the no ratio program. And there's basically a couple ways that these no ratio programs work. One, which is considered basically a true no ratio, means that nothing's measured. So in the case that I presented a couple minutes ago, where you had $3,000 in rent versus $3,000 in mortgage payment, and they met, the loan went forward. In a true no ratio, you could literally have $1 in rent a month versus $1,000 in mortgage payment, and the loan would still go through, because that relationship is not measured at all. The loan is strictly asset based and credit based. So there's no measurement of rent having to offset the mortgage payment by any means. It just again, it's not even looked at all. So that's a true no ratio program, and it does come in handy in a lot of cases because it allows the loan amount to stay higher when the rental income, either on a documented lease or in a appraisal, is insufficient to cover, to meet the payment. So that's one type of no ratio program. Another type is similar, but it's called the minimal ratio, and essentially what it does is it measures the rental income, but the rental income isn't sufficient. So to put this in numbers, let's say you had a mortgage payment of $1,000 a month, and on the appraisal, the appraiser identified the monthly rent of $750 a month. In the past, you would have had to put more money down to bring your payment down to $750, where those two met. With a minimal ratio or no ratio program, you're able to proceed as is. So the reason it's called minimal ratio is because the rent does cover some of the mortgage payment, just not all of it. So in this case, it covers 75%, and we're able to move forward with those ratios. So the things that, again, the benefits that this program provides, it still has the minimal documentation, streamlined underwriting, everything's based on this property, but there's less reliance on getting a very strong rental comp, and there's less, and as a result of when you do get a low rental comp, there's no need to put more money into the deal, because we have the option to go onto a no ratio program. So one thing I think it's one question we get quite a bit is, now why would anybody want to go into a loan knowing that the monthly rent they're going to get doesn't offset the mortgage payment? And it's a valid question, but it's when we explain how things actually work, it makes sense, because that's not the case. So the way these are underwritten, like I mentioned, they're out of the appraisal. So the appraiser goes out, says what the home value is, then they look at rental comps in the area to say what they believe the monthly rent is. Now, the first issue with that is, a lot of times, and especially during, through COVID, there were a lot of landlords, and not necessarily just with COVID, but just there's a lot of landlords out there that have a stable tenant, a tenant that pays every month, never misses a payment. And instead of continuing to raise their rents, even if rents in the area have gone up, say 7, 8, 10, 15% in some markets, in an effort to keep that tenant there and happy, they won't raise the rents. There are a lot of landlords out there that just prefer stable tenancy versus market rent and squeezing every dollar out of the property. And that is a struggle when an appraiser goes out and looks at rental comps, because a lot of times, unless you've had leases renew in the past 90 days right around your property, you're probably going to be basing your rental comps are probably going to be based on lease agreements that were signed, say 24, 36 months ago. And if you're following the rental market, there's been a drastic increase in rents over that time period. So because of that, just the rental number that we're using for underwriting, the bank's using for underwriting, you're not buying the property for that amount. You're not going into the property thinking you're going to get $1,800. You're probably speaking to your real estate agent and understanding that, you know, the appraiser saying this is $1,800 a month in rent based off these comps. But if I look at what current market rent is for this, it might be closer to $2,200 or $2,300 a month. So in that case, the person's not going into the loan as a, you know, net negative each month. It's just how the underwriting's done. Another scenario that we get quite a bit are people that are purchasing, particularly in the Florida market, for short-term rentals. You know, a bank, especially what the COVID years have done to the short-term rental market and just the travel market in general, a lot of banks are still underwriting, unless there's sufficient, 12 months of historical data on that property. Everything's going to be based on the rental agreement, or excuse me, the rental income in the appraisal, which is a long-term tenant. And, you know, the long-term leases are always going to be less than you generate as a short-term rental, especially in some of the hottest markets. Like, you know, if you look at Orlando or some other areas in Florida that do a lot of short-term rentals, the clients that are buying these properties know that the income they're going to generate each month is going to be more than enough to cover the mortgage payments, regardless of how we underwrite it and how the banks underwrite it. So it's a long way of answering the question of, you know, you're really not going into it as into the loan underwater. It's just a way to continue to purchase property and put as little down. So that's a piece on the no ratio program. And the next piece I'd like to talk about is a bridge loan program. And the bridge loan program is very similar in a lot of ways to the no ratio, except for the fact that it's quicker and it's easier. So the bridge loan program is strictly asset-based. You know, we have clients and lenders that can close a bridge loan in just a few days in some markets, all the way up, you know, on a long end to 2 weeks. You know, it's very much, sometimes there's not even an appraisal needed. It's really, what's the property? Does a lender like to collateral? What's the loan request? What's the exit strategy? Here's loan docs, and the loan goes to closing. So very easy. We're seeing these come into play a lot right now, just because there's times like this in the real estate market where quick closing and being able to make an aggressive offer and, you know, essentially an all cash or like an all cash offer and closing in 2 weeks can sometimes get you a much better price on a home than going through, you know, offering an aggressive offer and saying I need 30 days to close the loan with financing. If you can go into the seller and say, I'll give you this price, I can close in 2 weeks, you know, a lot of times they're a lot more willing to negotiate on the price and accept a lower price because they know the closing is going to come through in a couple of weeks. And that's where a bridge loan comes in. You can use it as a way to negotiate a quick close, a lower price, use rates as a way to really negotiate with the seller and you know, it slowed the market. The sellers are, if they want to sell the home, they're gonna have less people making an offer than they would have 9 months ago. So I think use the higher rates to your advantage to continue to buy the properties, and use the bridge loan or the no ratio to go through a quick close, painless close. And you know, I think the one thing that people do when they understand real estate in the States, it's the ability to refinance a loan down the road. So although our rates are, you know, fixed and our loan programs, you know, loan terms are 30 years, even 40 years in some cases, anybody that's doing a loan in 2022 is going to refinance the loan the minute rates come back, whether you're an American or foreign national. As soon as rates come back, which they definitely will at some point, they will refinance the loan at that time. So long-term real estate investors really understand the benefit of purchasing a property at a lower price than they would have been able to do, you know, earlier this year, and then refinancing it down the road. Another interesting request that pertains to the bridge loan that we've seen quite a bit in the past few months is actually cash out refinancing. So these are people or clients that live outside the country, have properties in the States, and have been able to have understood what the strong US dollar has done over the past few months and how that, or over this year, and how that relates to their local currency in their country. So a lot of requests that we've done just in the past 60 days are people that have a home that's either free and clear or has a large amount of equity, and we're putting a bridge loan on it to quickly recoup some of that cash in US dollar. They take the cash back to their home country where it's worth significantly more than it was even earlier this year. So again, there's several different strategies in play. You know, I think the thing to remember is it's always going to be, with the right time horizon, I think it's always a good time to buy real estate, and it's always good to find competitive and creative strategies to be able to still leverage as much as you can for the right property and get the right price. And our team of loan officers is, like I said, we're around the world. We're available to have a call anytime that's convenient to you. And we're able to discuss what your plans are for the property, and then what we think would be a good option for the purchase or the refinance. And then if there's, you know, if it's something like a bridge loan, we're able to provide a proposal for the bridge loan, and then also put a plan in place on what the exit strategy for that bridge loan might be. Say a refinance in 6 months if you're doing rehab on the home, or maybe a sell of the home if you're doing an investor that does fix and flip programs. There's a number of things that our team can help with and strategize with. So I forgot to mention, if you did have any questions, there's a Q&A box at the bottom of the tab there. So please put your questions in there. There are some questions loading now, and so I will go through a question and answer. Again, please put everything in there, and we'll tackle them one by one. First question, while the others load here, it says, how is one able to afford the bridge loan? The rate must be really high and rent won't nearly cover it. Does one use this personal income to cover the rate? So that's actually a good question, and I'm glad you brought it up, because it's something that I actually forgot to mention in the presentation. So with rates where they are, it's actually brought quite an interesting opportunity for financing, because if you're going to go through, rates are just elevated as it is. And if you're going to go through a traditional underwriting where we're documenting all your income in your home country, all your liabilities, in a full conventional underwriting, as a foreign national at 75% loan to value, your rate's probably going to be close to 9% in the given market. So that, again, that's a full process, 30 to 45 days close, full type of underwriting. The bridge loans, especially for the most stable lenders, you'd be surprised that they haven't moved rates. Some of them haven't moved rates at all yet, and the ones that haven't moved them much. So in a conventional mortgage, after going through that whole underwriting, you might be at 9%, and a bridge loan, we closed a couple last month at 9.9% or even 10.5%. So there is a spread, obviously, because there's more risk to the bank or the lender, because it's just strictly asset based. But it's not as much of a spread as there was earlier in the year, when rates were on a conventional loan were 4% and bridge loan rates were 10%. The other thing, there's also a couple other ways that you can afford the payment for a bridge loan, by either rolling up the mortgage payments. So that means if there's enough equity in the home, instead of having you make a monthly mortgage payment, the lender would hold back, say 6 or 12 months payments, and roll it into the balance of the loan. And then no monthly mortgage payments are due. And that comes into play a lot when people are doing purchasing a home or maybe, you know, constructing a project or rehabbing and then selling later. There's no mortgage payments that are due throughout the process because everything's rolled up into the loan. But good question. Next question is, what is the down payment required for the no ratio loan and bridge loan? So the bridge loans first, I'll speak on that piece. So that's, bridge loans are more based on the local market. So there's lenders that will get really aggressive in there. So if you have a Florida bridge lender, they're going to be a lot more aggressive on a Florida property because they understand the Florida market than they would in a Texas on a Texas property. So the down payment really ranges, but I think especially as a foreign national, depending if you're in a prime market and a prime piece of real estate, I think you can be in the 65 to 70% range on a bridge loan. We're doing a couple loans right now in the Florida market that are bridge loans as well. They are an American with established credit, so there's a little bit of a benefit there, but their LTV is at 75%. So 65 to 75%, I think in the bridge loan, and then the no ratio loan actually plays quite well into that as well. we had, up until a couple weeks ago, there were some lenders offering no ratio loans at 80% loan to value, which is only 20% down. That's come back a bit just as the investment market, kind of digest what's happening. But I do think that as there starts to be more clarity in the market, that's one thing that may start to come back. So again, the loan to values are going to be anywhere from 65 to 75% for both. What's the difference between a bridge loan and a hard money loan? Other than the fact that a bridge loan sounds better, there's really not, a lot of difference. Hard money is more of a older saying. There's where it's just, maybe a wealthy individual or wealthy couple of individuals pulled some money and did more opportunistic financing, charged higher rates, charged higher points. That market has really changed, and now the true bridge lenders, you're getting a number of institutions that are pooling money together, and their rates aren't as aggressive as, say, a hard money lender of the past might be. Like I said, they're only a point to a point and a half over what a conventional mortgage is. So the terms can be used interchangeably, but I think most of them would be considered bridge lenders now, because there's more of an institutional focus versus a like I said, just a wealthy individual or group of individuals. But same concept, very asset-based loans. Next question, what's the max term on a bridge loan? Again, great question. Bridge loans, like I said, they're short-term loans. There's a lot of lenders that are in the 12 to 18 month space for bridge loans. There are some lenders, again, for the right market and the right property, that will go up to 3 years, which is a pretty long term for a bridge loan. The thing about bridge loans is there's typically no prepayment penalty, or there's a very short prepayment penalty. So even if you're lucky enough to get a term sheet on a bridge loan of, say, 24 months or or longer, it's although the rate may be higher if you had a shorter term, it gives you some flexibility, because the prepayment penalty will likely be, say, 6 months or 3 months on a bridge loan. So you're typically going to be in the 12 to 18 month space, though. Next question is, can we use both bridge loan and a no ratio loan on commercial properties too that are already producing income from day one? So the answer is yes for bridge loans. So the commercial space is underwritten differently than the residential underwriting. But with interest rates, but in the commercial space, you're seeing the same sort of issues with commercial rates have gone up quite a bit, and the cash flow or properties that cash flowed really well at high loan to values earlier this year are not cash flowing at those loan to values anymore. So you are seeing a lot of people if they're going to go through a conventional underwriting, you're seeing them have to put more money down because rates have gone up so high on the commercial space. Or you see people that are going in and purchasing commercial properties or multifamily properties that have, maybe some rehab that needs to be done, or maybe there's some vacancy. They go in and fix some units, do repairs to the units, and then release them and get the net operating income up on the property, and then refinance it into a long-term loan. So you do see quite a bit of bridge loans being done in the commercial space right now, particularly because rates have gone up so much, and people are looking for more properties that they can go in, add some value to, get leased up, market rents, and then refinance into a traditional loan. But you usually won't see a no ratio loan in a commercial space, in a commercial underwriting. Next one is, would you consider a no ratio loan to be like an asset-based loan? Are the documents required pretty straightforward for American Mortgages, and it still classifies as a credit-based application? Yeah, so both bridge loans and no ratio loans are asset-based loans, because everything's based on just the appraised value. If you're an American and you have a US credit score, your credit score does, and your credit history does play into the pricing of the loan and the structure of the loan. And if you're a foreign national with no U.S. credit, that's still fine. A lot of cases we would still use your foreign credit report to be able to, if we're looking for some sort of like longer term, we would use your foreign credit report to show that you've got sufficient payment history and less of a credit risk for the bank. So yeah, both are asset-based loans. Both have very slim documentation, which our team would help you with. The documentation required is different for each lender and property, but again, our team's very versed in this and able to help guide you through that process. So I think that is all the questions we have. So again, I just want to thank you all for joining us. We will try to do these webinars more often as the market changes, as things progress, as programs loosen up. But I just want to stress that our team is available to answer any questions you might have. You can go on our website and easily schedule a call with any of our loan officers. And again, our benefit is we're around the world and we'll be in your time zone. So there's no reason to wait to US hours. You can do it during your hours. So thank you again for joining us. Hope you found this webinar to be helpful. And again, please reach out with any questions and we look forward to working with you. Have a great rest of your day.